Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in the markets this week and what might be driving them. I'm Merryn Somerset Webb, editor at large for Bloomberg UK Wealth. And this week, while John Stepek is out on holiday yet again, we have invited Morwenna Coniam to join us. She is part of the team that runs the UK Markets Today blog for Bloomberg. She has spent time reporting on EMEA equities, US stocks, FX rates. She has done it all, so she is just the person for the job. Welcome, Morwenna, to Merryn Talks Money.
Hello.
Good of you to come on. So this week, I think we have a pretty obvious topic to talk about: inflation, central banks. We had a new CPI number out for the UK today, which was higher than expected, although you do exactly have to wonder who we ask about these expected numbers, because I think I certainly expected to be reasonably high. Well, what did you expect?
Yeah, so it was expected to be the same. And it came in a little bit higher, but as you say, we've been kind of primed to expect it to be certainly well above the Bank of England target, and certainly something that is going to feed into those concerns that it's sticky and it's not coming down. And actually, we saw the core measure staying higher. And services as well. So those two things are going to be a bit of a concern, I think, for the Bank of England as they're deciding what to do with interest rates. They've been under a bit of pressure to sort of cut them faster, but I think the current inflationary environment means that they're going to be sticking to that cautious message because they don't want to fan it further.
We haven't mentioned the number yet, so to be clear, the number came in at 3.6%, which obviously is very significantly above the Bank of England target, which they now haven't hit for a very, very, very long time. At this point, it might be easier to change the target than to attempt to hit the target. Now, one of the things, that everyone is blaming for this is food retailers. So food prices were up. 4.4% was the number there. So that obviously fed through into quite a large part of the overall move. And the retailers have all been busily blaming, Rachel Reeves, basically, for minimum wage changes and changes to NI, etc. But maybe that's a one-off.
Well, I think that is the question, and that's what the Bank of England have been counting on, is that these inflationary pressures that we're seeing will be one-off and they won't be passed through to secondary effects. But when you do see some of those food prices, they are the staples, and that is concerning. And we're also seeing it in the services industry. So perhaps some of those things are not quite so easy to brush off. And there's also the uncertainty of the impact of tariffs, and we can talk more about that in the way that it is or isn't being seen in data so far. But certainly that people are going to be more cautious, I think, in brushing off the pressures that we're seeing.
Certainly we've had really noisy data all over the place, haven't we? Everything's a bit lumpy, and we know there's all kinds of stuff going on with payrolls, indexation, etc. So there's lots of mess in it, and there's still a really clear divide between the people who think that we've got an underlying disinflationary environment and the people who believe that really we're in for a long period of fairly steady inflation at a higher level than we would like. That argument still exists, right?
Yeah, absolutely. And when we've been hearing from the Monetary Policy Committee in their speeches recently, some members are more concerned about the inflationary pressures than others. And we saw that in the vote split last time. And so I think it will be quite interesting to see how they vote when we have the next Bank of England meeting next month. As we are expecting to see a rate cut, but I think how they actually vote and the commentary that comes out of it will be very, very interesting for what we'd expect going forward.
Yeah, so expectations are now that the Bank of England will cut at the next meeting, as everyone previously thought. Oh, that's quite a weird look to see rates being likely to be cut when the inflation rate is not far off double the target. It's an odd look, but nonetheless, that is what everyone is expecting. But then after that, expectations for further cuts have changed slightly, haven't they?
Yeah, so we have actually seen, those being dialed back a bit today. And I should add that it's been expected for quite some time that there would be a cut in August. They were on hold last time. So, they don't make a sort of flash decision on the day. Sometimes obviously it is more short term, but they have been guiding since February for these sort of gradual and careful cuts. So it's not really necessarily a response to what we're seeing right now, as opposed to the bigger picture and the path that they are trying to guide markets that they will be taking. But yeah, so we have seen them coming back a bit for the end of the year. Overall, still expecting the same amount that we were before, still expecting 2 cuts before the end of the year, but certainly paring away. And that's actually the opposite to what we've been seeing happening in the US today, where they've had their PPI has come in a bit softer than expected. And that's sort of reignited confidence in the Federal Reserve cutting interest rates there. So we've also seen a bit of a divergence in Treasury and gilt yields as well today.
So let's talk about gilt yields in the UK and what this means or doesn't mean for them. I mean, we have seen yields in the UK rather higher than elsewhere, thanks to a general perception that we haven't really got a grip of our financial situation, which we haven't. And when you layer onto that slightly unexpectedly high levels of inflation, what does that mean for the market?
Well, it's certainly a major pain for the government that we have got such high gilt yields. They haven't gone back down. They're higher than they were during the mini budget crisis in 2022, and that's something which is eating into the government's ability to actually budget. Their debt costs more to service, so that's bad news. And then what it means for sort of other markets going forward, it's just that there's that volatility now. I think that we're getting quite used to. Actually, we're seeing quite big swings, particularly in the longer dated debt, which isn't a good sign in terms of confidence in the market. And in fact, we just saw the other week when we had the incident in the House of Commons with Rachel Reeves, and there was some concern about her. We saw how the gilt market reacted then. So there's definitely quite a bit of sort of fragility in there, which I think we'd rather not be seeing, because obviously it has a knock-on impact on quite a few other things, including other asset prices. It affects stocks, it affects investors, and it just affects the certainty as well there.
Yeah, and of course we have the other part of that problem is that as we see inflation not coming down to where we'd like it to be, a very large part of the UK gilt issuance is inflation linked. So that doesn't exactly help us out either, right?
No, it doesn't. You're still, you're getting that supply, and it's certainly not making things any easier. And it just feeds into that sort of fiscal headroom, and it doesn't give them any room for manoeuvre when these things are all connected.
The other thing that's happened in the UK this week, of course, is we had Rachel Reeves Mansion House speech last night. We're talking, by the way, on Wednesday the 16th. So last night being the evening of the 15th. Was there anything in there that made you feel that something might happen? It felt to me like a lot of sort of rather vague announcements without any clear policy that might really lead to improvement for the UK market. Lots of nice things like, wouldn't it be nice if everyone was better educated on investment and felt like investing more like in the US? Wouldn't that be good for the market, et cetera, but very little that you could really hang your hat on.
Yeah, absolutely. There weren't really a lot of details. I think the message was clear, and that was, we're here for the City of London. We're going to try and stimulate growth, driven by financial services, cutting red tape, slashing regulation. That was the rhetoric that we expected, and that was the message that we got. In terms of actual details of policies, I think the ring fencing reforms are probably quite interesting in terms of consumer banking compared to other areas. But then there were still going to be some protections, so we don't quite know how that's actually going to work. I think the response from the city apparently was quite positive from those who were there, based on what our reporters who were covering it have said. But again, it seems to be largely sentiment driven. I think one other thing that came up that was quite interesting is the sort of IPO task force to try and stimulate the listings market in the UK, which has been having a terrible year after several very moribund years, and that's something that I think they're really hoping to see as they try and create this sort of more investor friendly environment as well for consumers. And I think that's one sort of other message there, is trying to get people more confident and interested in investing. And I think reigniting the UK stock market is sort of seen as perhaps one way of doing that too.
Yeah, it's interesting, isn't it, that she simultaneously wants everyone to invest masses in private equity by their pension funds, but at the same time to also invest in the listed markets.
Yes, that is a sort of, I suppose, a double-pronged approach there. And equally controversial perhaps, but I think the sort of overall message is that they want companies to invest in the UK as well, and that's not going to happen if the money isn't sort of there and the interest isn't there to help sort of drive the growth from those who do want to move here. And I think so trying to make the UK seem like an attractive place to invest domestically and for companies looking from abroad is really part of the mission there.
Maybe if we had lower inflation and better growth, it would work all by itself.
That probably would help.
Okay, well, the other thing that's interesting is there was. It looks like we've got away with there being no cut to the limit on cash ISAs.
Yes, so that no change there for now. I think that's something that, of course, is coming under a lot of discussion. I know that you and John have talked about it a lot previously, because it is seen as being this sort of pretty sacrosanct thing for a lot of consumers. You know, it's the only way that people can really save tax-free right now. But the question of whether it's taking money that would otherwise be invested in the UK or whether it's actually the sort of gateway for people to be interested in what their money is doing is, I think, probably the issue that's up to the debate there. You know, is it the same people who are maxing out their cash ISA limit who are the people who would otherwise be investing in the stock market? Not necessarily. So where that limit is and whether there's really much to be gained from it is the thing that people are kind of uncertain about.
Yeah, the question is not what they would do, but what they should do to a degree. I mean, John and I always talk about it and say, well, you know, who are these people who would actually need to have more than £20,000 in cash every year? And you have your allowance anyway, your tax-free allowance for interest from your cash, which if you're a lower rate taxpayer, you can have, depending on what your interest is, from between £20,000 and £25,000 in cash and not pay any tax on the interest as it is. And if the standard idea is that you should have 3 to 6 months of your income in cash in case of emergencies, and after that you should be invested, it would seem that an awful lot of the people who are in cash ISAs should be nudged into investing for their own sake, for their long-term wealth.
It might certainly, you know, be better longer term, but the mentality isn't necessarily there at the moment. And I suppose that's something that the government is saying they want to try and change, albeit they're not looking to do it in this way at this time.
And so that was one of Reeves' big ideas, that we should attempt to educate people more about investment. But these education programs, they rarely work, I'm afraid.
Well, it's difficult when people are focusing on their taxes, I think, to necessarily get them to sort of look at the longer term in that way. Yeah,
focusing on things that are a little bit more micro than perhaps they should. Right. Is there anything else that we should mention around what's happened with interest rates, with inflation, with what the Bank of England might do? Anything we've missed?
Well, I think what's interesting as well was we're getting into earnings season sort of in the US. And we're seeing whether over there the impact of tariffs is feeding through into prices. And as we said earlier, sort of the CPI suggests perhaps it had, but actually the PPI today has come out and sort of reassured some of those nerves. But we're also seeing some very strong reports coming through from US banks today in particular. I think Goldman had its best trading revenue ever. That suggests that they're not being impacted by the trade concerns. But then if you look at companies like ASML, they are a chip maker. They are a little bit more apprehensive, and they've been dialing back their guidance. And so I think we're only just starting to see whether the threat of tariffs, and the actual potential impact of those that have already been imposed is going to sort of hit companies and, on their bottom line as all these adjustments are being made. So I think that's something very interesting to watch, throughout this quarter, and particularly as the flurry of tariff announcements and changes keep coming from the US president.
Morwenna, have you been watching what's been going on with Crypto Week in the US? I mean, obviously, it's been a great week for Bitcoin, and my very small holding of Bitcoin is doing me proudly at the moment. Have you been watching it?
I haven't been watching it intensively, but I have been keeping an eye on the Bitcoin price, which has just absolutely been soaring. I think some people think the momentum is going to continue. It does tend to do well when, traditional assets are struggling. It's an interesting one because it is seen as being a risk asset. But it's also alternative.
Yeah. Okay. Well, this is a subject that we will come back to again and again and again. Morwenna, thank you so much for being with us today.
Thank you.
Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. Morwenna, are you on Twitter? X?
I am. It's Morwenna Coniam.
Also, be sure to check out our brilliant Markets Live blog at bloomberg.com/UK. This episode was produced by Samir Sadi, production support and sound design by Moses Ander. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.